afternoon. Welcome to the October version of Asia Credit Wrap. It's our monthly webinar where we run through the key themes that we're seeing during the month and areas that we think you should be interested in as investors and watchers of the credit world. My name is Pramod Shenoi. I'm the head of APAC research and the lead financials analyst, and I'm joined today by our Lakshmanan, Pius Xue, and Zerlina Zeng. So together, over the next 45 minutes or so, 50 minutes, we'll run you through what we see as most topical. So CreditSights in early this month released its 2026 preliminary outlook, a final outlook, along with all our sector snapshots, will be out about the 20th of November. But our preliminary outlook sets out how we see the world in 2026. So I'm going to turn to Zerlina first to walk us through what the outlook is about.
Yeah, thanks, Pramod. We are probably the first on the street to put out our preliminary outlook. We like to be either very ahead of the curve or be contrarian. I think that this year we are being very ahead of the curve. But we will revise our preliminary outlook in later early November together with the sector snapshot for all the Asia IG sectors as well as the European and US credit markets. So I will quickly start with our US macro and rates view because I think this is getting more and more important for Asian credit investors given the high correlation of Asian credits with the US market as well as US rates being a very important driver for Asia IG credit. So for this year, rest of the year, we're looking at 25 basis point of cut, which already happened yesterday. I think the market has largely reduced the rate cut bet for December, given the hawk of Fed power, and this is generally largely in line with our. I think the rest of the year will be a bit difficult given the Fed is data independent, but you don't really have out of the but the U.S. government and the curve has increased. We expect next year the U.S. labor market will significantly deteriorate and will dampen U.S. consumer put around U.S. inflation, allow the Fed to more aggressively cut another 100 basis points. Next year, the Fed composition, the voting committee will be a bit different, and will have dovish tilt, and that will also be favor of Fed cut. Are looking at U.S. 10-year yields to go down to 3% levels, entry level for you to add duration. Probably the where this opportunity is from now till year end or selected pockets of dislocation of the yield curve. Now moving on to Asia credit. We had a very good performance again this year. The Asia IG returned north of 7% and Asia high yield returned close to 10%. And we outperformed the European and US market. I think a couple of reasons underpinning this. The biggest one is definitely the technical. We still have persistent net active new supply coming from the Asian market, around 20 billion US dollar net active new supply, roughly in line with last year. Second reason being macro has been very benign. Asian central banks in the EM Asian region has been cutting rates, providing very good liquidity and local funding conditions and capping the high yield default rate. Our team has been tracking the Asia credit corporate fundamentals dating back to 1997 on a quarterly basis. What we could see is right now the corporate fundamentals are still quite solid and roughly above the historical mean levels, which is quite astonishing because given all the tariffs and all the negative headlines, geopoliticals, and a lot of changes, some political unrest here and there. But so far, it seems Asian corporates are holding up well. That said, spreads are very tight, and this is well known to the market. And Asian spreads yesterday just reached the historical tight of Asia IG 55 basis points. So we are now much tighter than European markets and US markets. So that means means there is a limited room for error. Position-wise for next year, given all these backdrop, we are preferring duration over credit risk. This has been our recommendation since second half of this year, has largely worked out. And given our relatively bullish view on US rates, we are maintaining this stance. In terms of duration plays, we prefer doing it through rates than credit, given the very flat credit curve across the global credit markets. In Asia dollar credit market, we still like the longer dated Japanese lifer sub debt. We still like the long dated quasis from Southeast Asia and Middle East and A-rated China tech, the long dated ones with a relatively steeper spread curve. We also this month come up with a convexity trade idea. So basically these are bonds with low dollar cash prices, and they are supposed to perform well when rates fall, but tend to have a bit more protection when rates go higher if there is a re-acceleration of inflation next year. In terms of the credit risk, we still think for IG investors, A and above credits, this is the core holding. Throughout the year, given the very aggressive compression for BBB, staying defensive has actually getting cheaper. For high yield investors, we still like double B carry, but to be very honest, if you want a 7% type of return, then you probably have to do some single B and triple C, and we are looking at some special sits, LME opportunities that might give you upside, and some of the single B with improving credit story and funding conditions. Lastly, we still like to diversify across different markets and different currencies, especially the Asian local currency bond markets. That doesn't mean that we are super bearish on US Treasury. We are so far not seeing a foreign buyer strike on US Treasury, and our US strategy team still thinks based on their fair value for 10-year US Treasury. Right now, we are actually kind of cheap. And technical will be more supportive for US Treasury next year, given in the last night's announcement by the Fed, they are already going to stop the quantitative tightening starting from December this year, and they will switch the purchase of MBS from MBS to US Treasury. So all these will providing some support to US Treasury, including some of the ultra long dated bonds.
Fantastic. You did briefly touch upon local currency, and I know that you've done a lot of work in this area over the last month. So what have you discovered?
Yeah, so in the beginning of the month, we did a performance overview for the Asia local currency government bonds. The performance so far this year has been pretty good, and most of the Asian local currency government bond actually outperformed or slightly behind the US Treasury. The good performing ones are the high yielding currencies, so your Indonesia local government bond, Thai government bond, as well as Philippines government bond. This is despite a lot of the headline risk related to these markets. Thailand market growth is slowing down. Indonesia, a lot of political concerns, political unrest, and in the Philippines, it's also kind of hidden by some of the rights-related issues, as well as recently some political unrest. I think the main reason is the market is really chasing the higher yielding currencies, and given the overall market sentiment is still pretty good, so these currency outperformed. And for the lower yielding currencies, interestingly, if you take into consideration the FX appreciation of the pairs like Korean won, CNH, Taiwan dollar, then these local currency bond markets also performed quite well. So I think next year investors will still have a quite strong mentality about diversification into local currencies, given the de-dollarization trend and general expectation of the dollar going slightly weaker, given the Fed is cutting. So I think it will still be very topical. Now I want to highlight two currencies. The first one is the Sing dollar. This week we put out a refresh note on some of the picks in the financials Sing dollar bond space. I think over the past 2 months, the technicals hasn't been really great for Sing dollar financials bonds for a few reasons. The first one is there has been a lot of Sing dollar corporate supply in the primary market, so some investors rotated out of the Sing dollar financials bonds, which are trading like at above par, like some of them are 106, 107. Second reasons being like there is still ongoing French political budget-related uncertainties, and there has been increased uncertainties related to the French banks. A lot of concern there, even though our French bank analyst does not think this is going to be a very big contagion risk, and we think the worry is a bit overdone. But we are seeing some of the selling, firstly in the AT1 space, also having some spillover to the Sing dollar tier 2 space as well. And lastly, it's the MAS published a notice of 637, again reiterating not selling the capital instruments to retail. This is nothing new, but again, this is kind of putting alert on investors' mindset. Given that we are looking again at this space, so we do find on the swap basis, so after swapping into the USD equivalent yield of most of the Sing dollar bonds are still quite attractive compared to their comparable USD bonds, particularly in the senior space. We like the Saudi National Bank senior. It's a short-dated one with good dollar equivalent pickup. In the tier 2 space, we still like AIA, Lloyds, and BNP and Credit Agricole. And the AT1 space, there is a Barclays bonds as well as SocGen, and BNP is still looking quite attractive. Then the last one I want to highlight is about CNH bonds. I think CNH bonds, largely this is driven by FX and rates movement. For the RMB, we expect a gradual appreciation towards year end. First is the PBOC, or China in general, is showing a goodwill towards the trade talks with the US. So if you look at the RMB fixing, it has been appreciating gradually towards the dollar, and we expect this trend to continue towards the year end. Towards the year end, because of seasonality, the Chinese exporters will be converting more dollar into CNH, so that's also supporting the RMB. And then on the rates front, it seems like the bond to equity rotation has slowed down, so we are seeing some stabilization of the CNH rates. So I think going towards the year end, that we will be seeing some continued demand, perhaps also supply coming to the CNH markets.
Thank you very much. That was very comprehensive, and you also, along the way, alluded to the good performance in local currencies, particularly Thailand and Indonesia. That's a good segue for me to move into the results of the banks from these particular jurisdictions. Actually, before I do that, just a reminder that in the bottom right-hand side of your screen, you'll find a Q&A box. Please do add your questions. It's a live session, so we can pick up your questions, and in case we don't answer them over the course of this webinar, we will get back to you. So those trends about good performance of local currency bonds were very helpful for the Thai banks, because that was very good for non-interest income. Interest income was lower on challenging net interest margins, and loan growth has been non-existent. So overall, not a happy story for the Thai banks as we had anticipated. Asset quality pressures have ensured that credit costs remain elevated. Bangkok Bank credit costs were higher. That's because they were the lowest, and as a result of elevated credit costs, they had to join the others. The one redeeming feature for the industry, though, is very high capital ratios, because there's no loan growth. Anything that is retained earnings and ex-dividends is basically accretive for capital, and so that's the good story over there. Indonesia, again, net interest margins being lower led to net income being down roughly 10% year on year for BNI and Mandiri. Loan growth, though, was up 11%. So overall net interest income stable-ish. So the banks as a whole, not too bad, but the macro situation hasn't hurt them too badly. Loan growth is actually up on the last quarter, so that's something that's interesting to see. Capital ratios continue to be solid. For both the Thai complex as well as the Indonesia complex, we have underperformed recommendations. The only exception is Krung Thai Bank, where we have a market perform recommendation on their sole AT1 bond. Turning very briefly to Indian private sector banks, it was actually a pretty good set of results from HDFC, Axis, and ICICI. Credit costs were lower than what it is that we were anticipating. They don't seem to be too much of trouble on the horizon. Loan growth, again, picking up a little bit. The Q3 is expected to be good because of the GST cuts in the festive season. We'll have to see whether that extends into Q4, the banks being a little bit cautious over there. Also, the ECL rules have been announced, and that's something that's going to be phased in many years into the future. So banks don't really need to be taking too much of provisions for that. So overall, a decent story there. We have a market perform recommendation on the Indian private sector banks. With that, we'll move on to initiations. We have released a lot of initiations. Yesterday, we totaled up how many we'd done during the course of the year, and they're 28, which is not a small number. And this month, we've released a lot. So, Laksh, I'm going to first turn to you for Saudi Electricity.
We initiated on Saudi Electricity in the push towards covering more of the Middle Eastern corporates and credits in general. This follows our previous initiations on the oil and gas names, and we have been writing on and off on some of the new issues that have been cropping up in the Middle Eastern space, even though we don't cover them officially right now. So Saudi Electricity is a state-owned electricity generation as well as transmission and distribution company. It has a monopoly in the latter, the transmission and distribution part, and in generation, it has control over close to 60% of the market share. The others are in the hands of independent power producers. The company is owned by the state, so of course it's almost like 81% in the control of the Kingdom of Saudi Arabia. That is through the Sovereign Wealth Fund and through Aramco. The strengths, we think that the key strengths include that it is of strategic importance, being the power producer and within the utility sector. It is has a very high linkages with the state. So therefore, if things turn down south, then the state is expected to step in. The company has a very, the model of a regulated asset-based kind of a model for determining the tariffs, which kind of ensures that the tariffs, or which is rather the revenue that the company generates, is regulated. It is has high visibility in terms of what revenue it can generate, and also that both the stability and the visibility is much higher. The company also is in a very defensive sector that lends a bit of comfort for us. The risk-wise, as with many other huge state-owned companies, it is has very high capex. It is in a free cash flow territory more often than not, and its net leverage is also similarly quite high. Even when we look at our forecast and our projection, the trend is that it will continue to deteriorate over the next 1 to 2 years. It's, and also finally, for some of these ESG conscious investors, it is predominantly in the fossil fuel generation space. So therefore, it's not really that ESG friendly. Given considering all these fundamental factors, with its peer or a similar rated peer Aramco, and with the Saudis, think that its spreads are tight. Thing to mention is that its entire dollar bond space consists of only sukuk bonds. There are no conventional bonds in its this one. So within that, so we think that it has room to widen by about 15 to 20 BIP in comparison and based on RV. And that's why we have assigned it an underperformer. It's less on fundamental reasons and more for the RV reasons that we have an underperform recommendation.
And continuing on with the theme of Saudi Arabia, so the financials team put out an overview on the Saudi banking sector, as well as initiated on 5 names in the sector, which are Saudi National Bank, Al Raji, Riyadh Bank, Saudi Awal Bank, and Bank Saudi Fransi. It was interesting looking at the Saudi banking sector because we discovered quite a few things. It's in pretty good shape. Capital ratios in general are high, and for the 5 banks that we've got under coverage, the average CET1 ratio is 15.4%. Loan growth is decent. They haven't had a negative credit cycle for a while, so NPL ratios are quite controlled. And there is some amount of variation, shall we say, in terms of coverage ratios. It has been a sector which earlier was corporate loan dominant, but under the Saudi Plan 2030, Vision 2030, there's been a lot of focus on giving some kind of subsidies for mortgages, as a result of which mortgage growth, not in the last couple of years because the subsidies have been reduced, but in a 3-4 year period before that, there was quite a big spurt in terms of mortgage growth. So the banks have got different models and different mix. Some are more corporate focused, some are more retail focused. But overall, the balance sheets look pretty sensible. The one area where there is a little bit of not really a concern, but one area where they aren't as strong is in terms of liquidity. The strong loan growth that they've been seeing has ensured that liquidity is, the loan to deposit ratios are quite elevated. In some cases, actually in most cases, they're over 100%. And any future loan growth is probably going to be from the bond market. So we do anticipate that the Saudi banks will be regular issuers in the bond markets going forward. The one area that we wish to investigate in some amount of detail was what is the implication of lower oil prices on the Saudi banking sector? Because what we have seen historically is that in case oil prices go low, then payments become a problem from the government. And if payments become a problem for the government, that kind of ratchets through the economy at large. What we have found is that a lot of the projects have now been placed under the Sovereign Wealth Fund PIF, and PIF is pretty liquid, and they've got a pretty large balance sheet as well. So our expectation is that should there be any kind of liquidity crunch as a result of lower oil prices, PIF is not going to be affected, and PIF will ensure that vendors are paid in time, and that too would be decent for the banking sector. Overall, we have a mix of outperform and market perform recommendations. Some of the banks actually don't even have senior debt. So the senior debt, there is opportunity for some, maybe not for others, but the real opportunity lies in tier 2 paper. It's the one sector where we've seen where tier 2 to senior multiples are above 2. In fact, it's closer to 2.2 times, which is a strong buying opportunity for us. One of the banks, which is Saudi Awal, for example, has a 31% holding by HSBC. If you were to look at the spread differential between 10 not call 5 and HSBC's 11 not call 10, you're talking about 70, 80 basis points. So there are basis points to be picked up. It's a sector that does look promising from a tier 2 perspective. So just something that we'd want to flag. If there's further discussions you'd like to have, please do reach out to us. The other sector where we took up some amount of initiations is in Indian NBFIs. So we have brought on board IIFL and we reinitiated on Manappuram. Manappuram had a dollar bond. It went out to the market. It's come back to the market. We reinitiated on them. We have market perform recommendations on both of these issuers. We see their bonds as trading fair. We see fair value for IIFL at about 125 basis points behind Manappuram. It's slightly wider than that, at about 135 basis points at the moment. And we see Manappuram at about 50 basis points behind Muthoot. It's tightened to about 35 basis points right now. On the tight side, but still acceptable. So Manappuram is a lender primarily against gold jewelry as collateral. That's about 2/3 of the loan book. They grew like the blazes in non-gold areas and burnt their fingers, so they're withdrawing from that part of the market or reducing their exposure. They are in the process of getting a huge capital injection from Bain, it was basically a family-run business. The family is now stepping back, and Bain is in the process of professionalizing management. Everything that we see over there looks pretty sensible. So 50 basis points, 35 basis points to Muthoot is a good place to start. IFL has been quite aggressive in the past and got wrapped on the knuckles by RBI. They have about 50% plus of their 50%-ish of their book is in gold loans, 50% in other areas. They had a higher gold loan exposure, but that's actually come down, but is on the way back up. The one thing about IIFL is that their capital buffer is pretty thin. It's in the 12-13% area. Their peers are 20% plus. That's something that we are cautious about, but the rest of the business model looks decent. One other area is that you might see lumpiness in income from them because they are in the process of or in the business of churning their balance sheet over and selling a lot of their assets, selling down their assets to public sector and other financial institution when it comes to priority sector lending. So we see, as I said, 125 basis points versus Manappuram as fair. It's slightly wider than that at 135 basis points at the moment. So those are some of the initiations. We should be coming out with Piramal as well in the near future. But from here, let me hand over to Zerlina, who is responsible for publishing NTT a couple of hours ago.
Yes, we just published this this company. So the recommendation is not so interesting. We do have a market perform recommendation on this, but I think the name is interesting because of the large amount of bond outstanding. So the company has close to 20 billion of US dollar bond outstanding and more than 13 billion of euro bond outstanding. I think overall, this company, we're quite comfortable with its leading market position in the Japanese telecom space. So this is the largest integrated telecom services company in Japan. The company is also 35% owned by the Japanese Ministry of Finance, and the government is also the largest shareholder. Because of this leading position, the company has quite stable earnings and cash flow generation. So these are some of the credit strengths of the company. But on the other hand, we do have quite a lot of concerns. The first is about the very competitive Japanese telecom market, especially after the entrance of Rakuten to become a mobile network service provider. This market has become very competitive. Then the Japanese regulators also occasionally put downward pressure on the pricing of mobile services. So that has placed a lot of pressure on the company's EBITDA margin over the past few years. Then the other area of biggest concern is about the company's very high appetite for debt-funded acquisition for expansion into the new business areas outside the traditional telecom services, particularly the data center related business lines. So this year, NTT issued 17.7 billion of USD and euro bonds in July to fund the buyout of NTT Data and a few other acquisitions. The company has an investment plan about 8 trillion yen from 2023 to 2027 to expand aggressively into the new business area. So far, the company has spent 3.4 trillion yen, so another 4.6 trillion yen to go over the next 2 years, and we expect most of this to be funded by debt. That also means the primary supply will continue from this name, both for USD bonds and euro bonds, and that might put some pressure on the secondary curve. That said, this company is already trading wider than the A-rated Japanese names, A-rated Asia credit corporates, as well as A-rated US telecom names. It is actually wider than a lot of the BBB plus rated US telecom names. So we see these downside risks are largely priced in, and that's the market perform recommendation. We do also take a look at the euro bonds. So on the dollar equivalent yield basis, we don't see much value. They are trading slightly inside the dollar curves. And the company also has $2 floaters. And so based on SOFR equivalent spread, those two floaters are also not so attractive.
Thank you very much. We'll then move on to Pius, who's initiated on Greentown.
Yes. Thanks, Pramod. So Greentown is a low BB developer credit, and at this point, it only has one bond outstanding. It's 500 million February 2028 bond, yielding at around 6.5% or 300 basis points. So we initiated on this name early this month with a market perform recommendation, and it's a trading. So we think that the reason is because it's trading fair versus it's a Chinese SOE comps such as a Jingmao and Yuexiu, and it's really reflective of its slightly lower credit rating, but then actually much stronger standalone fundamentals. Although it's a market perform recommendation, we still think that it's highly relevant because at the 300 basis points for a 2.3-year risk, it's still the widest quality developer out there. And we would be watchful for the buying opportunity. So just a quick overview of the company. Greentown is the number 2 largest Chinese developer by contract sales. In the past 12 months, they generated $35 billion contract sales. It's residential development property. It's its dominant segment. It has a pretty high quality set of land bank. 80% of the land bank resources are in tier 1 and tier 2 cities, and a lot of them are in good regions, Hangzhou and the broader Yangtze River Delta area. And one point worth noting is that its largest shareholder, it's China Communications Construction Group, CCCG, which is a central SOE with a very strong credit. A little bit, I will talk a little bit more about this point towards the end of this introduction. Overall, to summarize the company's credit strengths, it's implied state support from CCCG, high quality land bank, strong execution in sales, high liquidity ratio at around 2.2 times of cash over short-term debt, and a good liquidity access even during the past few years during the property downturn. It still has a good access to onshore bonds, offshore bonds, and syndicated loan market. And a few minor credit negatives in our view is that it still suffers a little bit of margin pressure from offloading some of its legacy land bank acquired slightly before the property downturn. That's late 2021. And it also has a relatively low attribution ratio at 65% because it has got quite some projects working with other developers. But then those developers are usually quality developers, not defaulted developers. So that's not that much of a concern. And I also want to spend 1 minute to talk about two key credit strengths. So as I mentioned just now, the one thing that we place a lot of value on it's state ownership by CCCG. CCCG is the central SOE, and it actually consolidates Greentown into its financials, and at the same time share its credit line with Greentown, which sets a lot, which basically means that it's taken Greentown under its wing, and it will prevent Greentown from default. And the perception of it allows Greentown to maintain low-cost, smooth access to a wide range of funding options. And then secondly, it's also its standalone fundamental. It's quite strong, and as mentioned just now, it's actually stronger than higher-rated SOE developers like Jingmao and Yuexiu. We estimate that its asset coverage ratio is somewhere between 1.6 times to 2 times, and that's taking into consideration its land bank's resource value, capex to finish those land bank, and its net debt level. And we are somewhat quite comfortable with the realizability of its assets, just given 80% of the resource value is in tier 1, tier 2 cities, and it does have a good track record in divesting the legacy land banks as well.
Great. No, thanks for walking through that. And you also put together a note comparing performing private sector credits in China. So could you walk us through that?
Sure, absolutely. Yeah, so this is really a Chinese property month for me. Yeah, so I'll be talking a bit more about properties. And so we published this note 2 days ago on Tuesday. It's an informational note on really the three topical surviving POE Chinese developers. That's Shenzhen, Longfor, and Vanke. So this note is really in response to rising investor interest, because when I had conversations on other credits with our clients, these names usually come up. They usually want to ask our view as to either I say on a even on a non-official basis, as to how we think about these credits, what are the events to watch out for. So this note has high relevance there. And also because these bonds issued by these names are offering at optically high interest rate, coupon rate at 8 to 20% also. And this is in the context of much tighter yield elsewhere in the Asian credit market, and also against a stabilizing macro outlook and supportive policy backdrop as well for the sector. So among all the credit considerations, we assign particularly high value to really four credit considerations. One, it's stability in recurring income. Second, it's the company's abilities to fund its short-term maturities. And then thirdly, it's sustainability of capital structure. And specifically in the case of a Vanke, the shareholder support strength. As to recommendation, we did not provide a specific numeric number for fair value, but we rank these three developers in terms of their relative risk reward based on the key credit considerations as mentioned just now. And among the three, we like CZN the most. CZN has 3 bonds outstanding of 1 to 2 year duration to work out and yielding 13%. For the other 2 developers, Longfor and Vanke, we think that they are trading at fair level against their risk reward, against their own risk profile. And I just want to also, lastly, also want to highlight a few key credit metrics of these 3 developers. For CZN, we like its growing rental income. In the past 6 months, it grew by 11% year over year. And we also like its high rental gross profit over cash interest at 2.7 times. And we are comfortable with its liquidity in the short run. It's 60% of the short-term maturities are basically backed by well-performing operating properties. The remaining 36% are dollar bonds, but 20% have been refinanced already, and 16% we think that they can tap the market again. And the company also has other options to address that if need be. For Longfor, it has the strongest credit fundamentals among the 3. It generated 10 billion. It's expected to generate 10 billion of free cash flow for 2025. It has got a high recurring gross profit over net interest of 2.2 times, and its average debt maturity is quite long at 11 years. So accordingly, it's also trading at the tightest level. Its 4 bonds are trading at the low 8% also. For Vanke, lastly, Vanke has the weakest standalone fundamental among the 3. For the first half, its cash flow was negative at 10 billion, and it has got a low free cash over cash interest of 0.44 times. But really, the strong positive about Vanke, it's state ownership by Shenzhen Metro. So since the beginning of this year in January 2025, since the management reshuffle initiated by Shenzhen Metro and the Shenzhen government, Shenzhen Metro has injected 24 billion of shareholder loan into the company to help plug the maturity need for onshore bonds of 24 billion. And as we understand, it also facilitated 25 billion of refinancing from other financial institutions for the refinancing of debt elsewhere. So therefore, just given that we still think that the state support is there, it's intact, so we would also be watchful for the buying opportunity in the case of Vanke.
Thanks very much, Pius. So that's view of the different initiations and some of the deeper dive notes. We'll now move on to more topical notes. There's been some amount of corporate activity in, shall we call it, in Southeast Asia and Lux. I think we've got both Genting as well as the Thai SOE sector where there's some amount of action. So could you walk us through that, please? And any changes and recommendations thereafter?
Yeah, sure. So the Genting, it's a topical name, and it garners client as well as investor interest from time to time. And about a few weeks ago, the parent Genting Berhad, Gent for short, came out with an announcement that it is looking to acquire residual stake in its key Malaysian subsidiary, Genting Malaysia, for a total sum which could go up to MYR 6.7 billion. That's close to about $1.6 billion. Currently, it owns just shy of 50% stake. Now, it has given an offer to the residual shareholders, which are a diverse set of various institutional/retail holders. Now, first off, we think that as such, the move is credit negative for the parent Genting. That is because this takeover will be mostly debt funded. So it will lead to an increase in its debt levels, but there won't be a commensurate increase in the EBITDA level because it already consolidates Genting Malaysia. So we think that it is therefore negative for Genting because it has also kind of pledged that it will support the future requirements to develop the new New York casino once it is won by Genting Malaysia, which is expected in a couple of months. So given that there is a certain degree of transfer of risk from Genting Malaysia to the parent Genting, we think that that is a bit more riskier, and therefore we are more credit negative on that. Now, when it comes to Genting Malaysia, even though some rating agencies have pegged its rating to the parent, however, as far as this transaction is concerned, we think that it is actually credit positive for Genting Malaysia. This is because, one, as we just mentioned, there is a bit of a transfer of risk to the parent from Genting Malaysia. Secondly, a certain bit of the strengthening of ties with the parent Genting means that there will be more support in terms of both financial for the build out of the New York casino, which actually sits under Genting Malaysia. So all this means that both the stronger parental ties and a little bit of lesser financial burden means that it is more positive for Genting Malaysia, and therefore that drives our more positive view on it. In terms of rating agencies, we think that it reduces the rating headroom from a couple of agencies for both these companies. Moody's followed up by putting a rating watch negative on Genting, which is the parent, which then ties in with our kind of view on the group. We think that it, as we think that the parent may be able to acquire somewhere about 50 to 60% final, because offer is not that attractive, our opinion. In terms of the offer, based on our assumption for how much it have to take, we think rating downgrade as such is less likely, but then of course we see that overall the direction is in the negative way. Fit also actually similar direction and company watch negative. With respect to the recommendation, like just spreads due out to over 200 bps. There is a stronger parental ties, and then ultimately there is more support coming in for the New York casino. So a mix of all this meant that we more in favor of making the Genting Malaysia's bond more attractive. We stuck with the market performance on Genting, but that was mainly because their spreads also blew out, and from where they were right then, we felt there is no more kind of spread widening potential from there, and we stuck onto that market performance. So the second part of the question on Thai Oil and PTTGC, that's also fairly interesting, given both are, even though they are IG rated, and similar was the case with Genting, they're all IG rated, but they behave and act like high yield, and the risk that is reflected in the spreads the market also says that they are pretty much seen as a little bit like crossover or high yield. So even in the case of these SOE companies, Thai Oil and GC, they acted on their more well-publicized asset monetization plan. So they took some measures towards it. That involved mainly selling some of their assets to its parent PTTPCL. So generally, the asset sales are credit positive for both companies because they will use the proceeds for paying down debt for deleveraging, so which is good. But then where we are slightly disappointed on is because we don't see or project that these asset sale generates enough cash to really move the needle in terms of their pro forma credit metrics. We still think that there will be an improvement, but then their metrics will still remain highly elevated. So in GC's case, it is in mid 25, 26 range. For Thai Oil, it is in 11, 12 times range. We are talking about net debt to EBITDA. So given these, we think that there will be diminishing fallen angel risk, but then that risk will not totally go out of the window. We expect that the rating agencies will take more time before they act even negatively on these names because of these asset sale, but that risk has not totally gone away. Thai Oil, as we mentioned, has higher risk because it has rating only from 2 agencies. So if Moody's downgrades them, then they will more or less go into junk categories, whereas in GC, it has the buffer that it has ratings from 3 agencies. So even if Moody's, which has a negative outlook, downgrades them, for example, still they will remain in the IG category. So that's where we are at, and we do not change our recommendation on both names.
Thanks for walking us through that, Laksh. And we'll finally wind up with Zerlina. So Zerlina, you were traveling this week. You're in the Philippines, lots of interaction with investors. And in general, you've also had a lot of calls over the course of the month. So what have you found from your engagements?
Yeah, so after we published our preliminary global credit outlook, we were in conversations with a few clients. I think the general feeling or observation is towards the year end, clients are getting quite defensive to lock in the good year-to-date total return performance across both IG and high yield. So we noticed clients are trying to stay a bit up in credit quality, even for sectors like gaming or auto sectors, because in general, staying with the bigger players with better credit trajectory. And in terms of the duration, we noticed a lot of clients did add duration starting from second half of the year, but recently they have been cutting again, giving there are still Fed decisions, lack of US data, there will be volatility. So towards the year end, feels like positionings are getting quite defensive. And there has been increased concerns toward credit markets in the US as the CL market. Our US strategy was expected default rate will careful handle the US corporates and not expect the idiosyncratic out from some of the auto dealers and part related will be systemic or will be contained the other sector. Overall, if we look at the quarters of region US performance overall is solid. So this point, we think this is the start of the default cycle. Has been a lot of questions, especially if kids like CL experimental sense. When it comes to spread, as we remember in terms of spread going wider, but given our evaluation has been so stretched, so we did not get as much pushback, but I think most of that positive towards next year, citing reasons like technical, macro, corporate fundamentals. I think most of clients think Asia can still stay inside US IG as well as Euro IG, and we do kind of agree with that given the technical and fundamental there. I think when it comes to the local currency bond market, this is still very high interest. We have more clients talking about allocating cash or the redeemed coupons and some principal repayments into the local currency bond space. There is a new index inclusion for the Korean government bond into the FTSE, and then there's a positive review for Philippines local government bond by JP Morgan. So the momentum is there. The areas of interest still, again, is Aussie dollar, Sing dollar, and CNH. And lastly, to our surprise, it seems like the clients are not so keen in the euro bonds. Some of the reasons they cited are the fiscal outlook is not so clear. There will be increased supply from Germany and other euro markets, and ECB might slow down in terms of cutting, and our house view is no cut. And the rest of the year and next year, we're actually looking at 25 basis point of hike towards the fourth quarter. Do have some pushback on that, but I think overall, relatively speaking, people are still more constructive on dollar duration versus the euro duration. So interestingly, despite a lot of the fund inflow into the market, we feel like the interest from the Asian clients are actually not that high. Aside from those are betting on the appreciation of the euro, but giving the double-digit appreciation, a lot of the clients are also expecting the momentum will slow down a bit into next year.
Thanks for that, Zerlina. And just a quick alert to our clients that around the 20th of next month, we'll be publishing our final 2026 outlook. Along with that will come sector snapshots for all the sectors in Asia, Europe, and US indices. So do watch out for that. That's what we'll be going through our next monthly webinar. Thank you very much for joining us today, and we do hope that you join us next month as well. Have a good day ahead. Thank you.